Right now is a once-in-a-generational opportunity for you to build wealth, because right now it could be one of the easiest times to increase your net worth dramatically, if you know what you're doing. After all, there's a popular saying that riches are made in recessions, and it doesn't take much time to realize that we're already beginning to move towards that point. The fact is, recessions happen on a regular basis, and if used correctly, it's possible to set up the rest of your life through some incredible opportunities and discounts. Even Warren Buffett says, quote, "Bad news is an investor's best friend." So let's talk about exactly what's expected to happen throughout these next 12 to 24 months. The next best benefits that you'd be able to take advantage of today, and precisely what you can do to make sure you're in the best position to make as much money as possible. So smash the like button if that sounds intriguing, right down below, and let's get into it. Now, before we talk about the best upcoming opportunities, you probably first want to understand what the heck is it that you're going to be going up against. And to start, we need to talk about a recession in generalized terms. Recessions are accompanied by a significant rise in unemployment, a drop in wages, a loss in consumer confidence, and a decline in value across everything from stocks, food, energy, and services, with sometimes long-lasting effects throughout the entire world. But along with recession usually comes a decline in earnings. Then there are layoffs. When consumers earn less, they spend less, and when companies see less demand, they begin to scale back on their expenses, with usually employees being the first thing to be let go. In fact, just a quick Google search for mass layoffs shows you dozens upon dozens of companies who are all trimming their workforce, and as Bank of America explains, the U.S. economy will soon start losing 175,000 jobs per month. So in terms of what this means for you and your investments, as well as how you could use this information to make money, let's start here with number one, stocks. As of now, all three major indexes are down between 20 and 30%, with analysts like JP Morgan who believe that we have another 20% to go from current levels. However, if we take a look throughout history since 1946, the average bear market drop was close to 30%. With the most severe having been in 2009 when the S&P 500 fell 57% from its peak. Now, once you combine the average with recession, bear markets tend to do even worse with an average drop of 34.8%, which, just for reference, right now we're down about 25%. All of that just to say that generally the absolute bottom occurs when we see capitulation across investors. Usually that's a time of the start of the recovery and things begin to bounce back. Now, I'll be covering exactly for you how much you could be making from this in the next few minutes, but first we have to talk about number two, real estate. Even though every area of the country is different and some locations might continue to flourish, housing declines on a national level are actually incredibly rare. In fact, as you can see, throughout the last 60 years, there have only been a few times where prices meaningfully fell more than 10%. But now the general Wall Street consensus is that the national housing prices are going to decline 7%, with a worst-case decline of 10 to 15% should interest rates continue to increase. Of course, every market is going to be different, and according to Moody's Analytics, the most valuable markets could see upwards of 25% decline from the peak, including parts of Florida, Arizona, Idaho, and Southern California, with the decline lasting another 12 to 18 months before bottoming out. Now, in the big picture, it's probably not going to make that big of a difference for anybody with a fixed-rate mortgage who intends to stay on their property for another 5 to 10 years, but for anyone looking to invest or buy a house, we may begin to see some deals starting to come up on the market, which we'll cover shortly, because we'll also have to talk about number three, cash. Clearly, up until now, there's been this mindset that cash is wasting away to inflation, but when every other asset is falling in price, sometimes cash could be the safest place to store your wealth. And you know that's significant when someone like billionaire Ray Dalio admits that cash is no longer trash. The truth is that many people forget as recent as 2018, cash was the best performing asset, and had you just been saving your money in a high-yield savings account, it would have been far outpacing the market. Cash is now becoming such a significant part of the portfolio that even fund managers are holding on to the highest amount of cash since 2001. Think about that. And Citigroup just said that cash is the only asset that investors could use as a recession hatch. But as far as what you could do about this to make money and why so many people never take advantage of what's about to come, here's what you need to know. All right. So in terms of why this next recession could be a once-in-a-generation opportunity, just consider this. Everything becomes less expensive, the way I see it. Even though one person might think it's a bad time to invest, everything is falling 30%. A wealthy person would see this as an opportunity to be able to buy those exact same companies for a 30% discount. When stock goes down and you can get more for your money, people don't like them anymore. So first, reframe your belief, because a falling market could work for your advantage. The second thing is there's less competition. The fact is, when times are difficult, companies scale back, they fold, they save cash, and they play it safe. But this opens the door for smaller, more aggressive companies to stand out in their place. For example, one study across 16,000 companies found that those who continue to advertise increase their value and get more bang for their buck with positive growth years after the recession's end. The third thing to note is that there's way more opportunity. In a way, a recession is the market's method of weeding out the weak, and Patrick Bet-David made a fantastic comparison a few months ago that the peak of the market cycle is exactly like a forest. This means that only the largest, most established trees or companies get access to all the resources, or in this case, sunlight. Everything at the bottom has a difficult time being able to compete, and it's hard to grow. But just like natural forest fires, our economy has a way of repeatedly clearing out and bankrupting companies who no longer are able to sustain themselves, giving opportunities for newer, smaller businesses to continue to develop. Now, fourth, after every bear market comes a bull market. As Yahoo Finance points out, historically, the S&P has fallen an average of 29% around a recession, with a median drop of 24%. But once stocks have found their low, the average return the following year is 40%, and within 2 years, the market has increased an average of 58%. This means that investing in the way down is pretty much more profitable than pulling out of the market and waiting. And long term, the market has always recovered in every single example so far throughout history. And fifth, you have to act before anyone else knows about it. The truth is, recessions are never confirmed until much later. For example, the Great Recession that began in December of 2007 was not officially announced until December 2008, only a few months before it officially ended the recession. Looking back at different recessions, there seems to be about a 6 to 12 month delay until we actually know we're in a confirmed recession. But in terms of what you could do about this to profit, number one, scale back your expenses. This means that you track your market, cut back on unnecessary spending, and operate on the low while you continue to reinvest as much as possible back into the market. This should also include a plan on what you would do if your income were to drop 20 to 50%, how you would make up the difference, and if you could take preventative measures ahead of time to protect yourself from that happening. 2. Hold on to some cash. Having cash to fall back on just gives you peace of mind. For me, cash makes up anywhere between 15 to 20% of my portfolio, and generally this has given me so many opportunities to jump on good deals when I find them, and it lets me sleep at night knowing that no matter what happens, I have something to fall back on. 3. Protect your career. This is going to be your best hedge against whatever happens, because financially, your worst case scenario is not the market going down, but instead it's the market going down at the same time that you lose your job and you have to sell off your investments at the bottom before they have time to recover. So now is the best time to improve yourself, learn new skills, and double down on whatever you're currently doing. And then 4, invest long term. The best course of action when it comes to investing is to simply carry on as usual and pretend like nothing's happening. It's shown that dollar cost averaging, or the practice of buying into the market on a regular basis, is the most profitable strategy. So stay in the market and continue buying in. And 5, diversify your investments. Now, if you can't personally handle a 20% drop without panicking, that's probably a sign that you're invested too aggressively. For instance, if you're completely in U.S. tech stocks, then it's probably a good idea to add large cap and international stocks to the mix too, or potentially look into investing in real estate or renting REITs. The more legs your portfolio has to stand on, the less likely it's going to collapse should one or two of them fall out. So those are my recession tips covered. If you found this video helpful, be sure to like, comment, subscribe with notifications turned on, and I'll see you in the next time.